So you're building your investment portfolio, right? And like so many of us, you probably dream of having it all. You want that explosive growth and a steady stream of income.
The perfect world scenario.
Exactly. But in reality, it's often a bit of a pickle, isn't it?
Yeah.
Usually the more you chase one, the less you seem to get of the other.
That's the classic trade-off.
But what if I told you there are some pretty fascinating investment vehicles out there? One's designed to maybe give you that proverbial cake and let you eat it too. They basically aim to transform positions in high-growth companies into holdings that also somehow generate income.
And that's precisely the intriguing territory we're diving into today. Our specific focus is going to be the YieldMax SMCI Option Income Strategy ETF, ticker SMCY.
Right, SMCY.
Which centers on supermicrocomputer SMCI stock. Now, it definitely promises income, but understanding the underlying mechanism, like how it actually does that, is absolutely crucial for you, the listener.
Yeah.
Even if you never plan on directly trading options yourself.
Exactly. So our mission in this deep dive is really to unpack what option writing truly entails. How this particular ETF puts that strategy into practice, what kind of returns it has delivered, and maybe most importantly,
the risks.
The risks and the inherent downsides you absolutely need to keep in mind. Let's unravel this. Okay, let's start with the big question then. What the heck is option writing? I know for a lot of investors, maybe even some seasoned ones out there, options can sound, well, intimidating or just plain unfamiliar.
Oh, absolutely.
And that's perfectly okay. Nothing wrong with not knowing. But for funds like SMCY, grasping this core idea is pretty foundational.
Right. So in its simplest form, an option is basically a contract. Think of it like a bet.
A bet.
Yeah, essentially a bet on whether a specific stock or maybe an index will move in a certain direction within a set time frame. You've got call options. Those are bullish bets. You're predicting the stock price will go up. And then there are put options. Those are bearish bets. You're betting the price will fall. Now, when you buy one of these contracts, you pay a premium, like a fee, for the right to make that bet. That's usually how most people think about them.
Right, buying options.
But what's really insightful for income investors is understanding the other side of this bet, the writer or the seller of that option, the person who receives that premium payment right up front.
Ah, okay. So that's where the writing comes in. So instead of buying options and hoping to sell them for more later, you're actually selling them first, which means you pocket that premium, that cash, immediately.
That's it.
The goal then is what? To either buy those options back later at a lower price.
Or ideally,
just let them expire, worthless, right? So you keep the whole premium.
Exactly. That upfront cash is the essence of option writing and why it's so appealing if you're looking for income.
Makes sense. You get that immediate cash.
Precisely. But this immediately raises a really important question. What are the risks involved with this general strategy?
Okay, yeah, good catch.
Well, the chief risk is that you might be forced to buy back or cover these option trades at a price above what you initially sold them for.
Ouch. Locking in a loss.
Locking in a loss, exactly. Now, for the specific strategy YieldMax uses, which is called a covered call strategy, it's even more critical. This is because they already own the underlying SMCI shares. Those shares are basically serving as collateral.
Right, they're covered.
They're covered. So the risk here is being forced to hand over those shares, usually while the stock is rallying.
Ah, so you miss out on the upside.
Meaning you're essentially missing out on much of that ticker's continued upside potential. That's why option selling can be, well, such a tricky business.
Okay, so if they're selling options against shares they already own, how does this actually play out for the YieldMax SMCI Option Income Strategy ETF for SMCY?
So the fund managers, they regularly sell call options against the shares of supermicrocomputer that the fund holds.
Day in, day out kind of thing.
Well, maybe not day in, day out, but regularly, yes. It's their core mechanism. This generates that ongoing income, and the bulk of that income is then distributed to the fund's owners, usually each and every month.
Monthly income, okay.
And because the fund also owns those SMCI shares, holding SMCY is, well, somewhat akin to holding a stake in the stock itself.
So they move together, sort of.
Yeah, they generally move in the same direction, maybe not to the exact same degree, but the correlation is there.
And here's where it gets really interesting, right? The numbers. Since its launch back in September of last year, SMCY's net asset value, its market price, has, well, unsurprisingly, trailed the pure performance of SMCI stock. That makes sense given the strategy.
Right, you'd expect that with covered calls capping some upside.
But T, and this is a significant but, it is also dished out an astonishing
Cat.
$20.20 worth of per-share dividends or distributions during this time.
Wow.
That dividend amount is roughly double the ETF's current market price.
Double its price in dividends alone.
Yeah. So the surprising result is that SMCY has almost kept its total net return when you include those distributions, pretty much even with Supermicro shares performance during this stretch.
That's incredible.
It just delivered about half of this performance in the form of dividend income instead of capital gains. Can you believe that?
Yep.
SMCY's trailing 12-month dividend yield stands at just over 100%.
Over 100% yield. That number just jumps off the page.
It really does. It sounds almost too good to be true, doesn't it? You're potentially getting most of the net benefit of owning a really hot growth stock. But a huge chunk of that benefit comes as cold, hard cash every month.
Yeah.
For certain investors, maybe especially those who like to constantly accumulate cash to, fund new growth investments, it really can look like a compelling alternative to just outright owning SMCI.
It certainly has that appeal on the surface.
But what's the catch? There's always a catch, right?
Well, yes. There are crucial downsides and risks that you absolutely need to consider. It's not free money. While the ETF's managers are, incredibly skilled and they do a great job balancing the inherent risk and reward, some risks simply can't be managed away entirely.
Okay. Like what?
The big one, as we sort of touched on, is that SMCI shares could unexpectedly soar, just take off.
Right.
And the fund is then forced to hand over those Supermicro shares right in the middle of a massive rally.
So you sell low, relatively speaking.
You miss out on the stock's continued, maybe explosive upside. That potential is capped. Alternatively, the fund might be forced to buy back the options they sold, but at a higher price than they initially received.
Covering at a loss.
Essentially locking in a loss on that specific option trade. Remember, the call options that YieldMax sells gain in value when SMCI rises.
Which is good if you bought the option, but bad if you sold it.
Exactly. It works against the strategy here. SMCY's managers want the value of the options they've already sold to fall or ideally expire worthless.
So a big rally in SMCI is actually problematic for the strategy.
It can be, yes. Sooner or later, this scenario, one of these negative outcomes, it will happen. It's just the nature of selling options. And even if it only happens occasionally, it can hit the value of the fund pretty hard, pretty fast.
Okay, that's a big one. What else? Then there's the other downside that directly impacts your returns. The cost. The cost of managing such an active fund.
The expense ratio.
Right. Unlike those enormous, super low-cost, passively managed index funds like the SPDR S&P 500 ETF or the Vanguard S&P 500 ETF.
Which are fractions of a percent.
Tiny fractions. The YieldMax SMCI option income strategy ETF's annual expense ratio, basically the management fee you pay each year is quite hefty. It's nearly 1%.
Almost 1%. That's significant.
And despite what some fund companies might try to argue, that does take a direct toll on your net performance over time. It adds up.
And here's another important financial consideration, something you really need to factor in. Income-generating funds like this one, they tend to create a pretty big tax liability every year.
Taxes on the dividends.
Because those monthly distributions are essentially treated as dividends, after all. You get paid, you owe tax, generally speaking.
Right, unless.
And what's fascinating here is this is why it's often especially relevant if you hold such a position within a tax-deferring retirement account.
Like an IRA or a 401k.
Exactly. In those accounts, you typically don't pay taxes on the income year to year. It just stays in the account, allowing it to compound more efficiently without that immediate tax drag.
Okay, that's a really important distinction. So after weighing the pros and cons, the high yield, the risks, who exactly is this kind of ETF for? When does something like SMCY actually make sense?
Well, I think it's particularly appealing for growth investors who would genuinely like some of their gains delivered in the form of ongoing income, rather than purely waiting for capital appreciation down the line.
So mixing growth potential with cash flow.
Right. And as we just discussed, it's especially relevant if the position is going to be held within one of those tax-deferring retirement accounts to help mitigate that annual tax liability from the distributions.
Makes sense.
But the key, really, the absolute key consideration here is just figuring out whether or not the underlying stock in question,
Supermicro in this case.
Supermicro is worth owning in the first place for your specific portfolio and goals. Because look, if you don't actually want to buy and hold SMCI for its own merits,
Yeah.
The income aspect of the YieldMax ETF alone doesn't really make it attractive enough to matter. It can't turn a bad investment into a good one just by adding yield.
Got it. The underlying asset has to be sound first.
Fundamentally, yes. It's not just about the yield, it's about the quality and prospects of the underlying company.
Wow. We've certainly uncovered a fascinating strategy today. It's one that offers a really unique, if pretty complex solution to that age-old investment dilemma, wanting both growth and income.
It is complex.
And it's truly surprising how SMCY has managed to deliver about half of its total net return in the form of dividends, almost keeping pace overall with the underlying growth stock itself. Pretty remarkable, actually.
It is. So considering the complexities we've talked about and those unique risks, especially missing out on potentially explosive upside for the underlying stock, plus the higher fees and the tax implications, does the pursuit of such high dividend yields through a strategy like this truly align with your long-term investment goals? Or is maybe the simplicity, the straightforwardness of outright growth of stock ownership actually a better fit for what you're trying to achieve? What really stands out to you from this deep dive? Something to think about.